Welcome back to my channel, Balance Sheets Matter. I got another subscriber request to do a stock analysis video on Ulta Beauty. That's ticker ULTA. Now, this is a great stock to do an analysis on because I'm very familiar with Ulta Beauty. I've owned it in the past. I've made good profits on it. I probably will own it again in the future if it gets to a good price. And if you're interested in having a stock looked at, me doing a stock analysis, leave a comment below. Also remember to subscribe to my channel and of course, like this video. Now, Ulta Beauty is a great stock to do an analysis on because this is a company that's in transition. It's transitioning from a company that was much higher growth before and it's more moderating in growth. So a lot of the same relative valuation metrics I typically use do not work the same. And this shows that it's just not that easy to pick stocks and just, buy when the price to sales ratio is low. It's a lot more complicated than that. So let's take a look at first some of the high level metrics here. You can see the little groove focus band here. It's showing it undervalued. I do not believe this to be correct because this is using the past data, past high growth trends, which likely are not going to happen in the future. And we can also see P ratio of 16.6 with a forward P ratio of 16.4. And Ulta Beauty does not pay a dividend. They just focus on buying back shares. So let's jump into financials on this company here. So you can see basically we have our revenue here and our revenue estimates, and you can see the revenue estimates very, very slow. They're expecting, maybe like 500 million on 11 billion in sales over 1 year there, and then maybe another like 600-700 million on almost 12 billion. Very slow growth. And this is from a company that was previously, its last 10-year compounded annual growth rate was 18% per year. So they were growing really fast and this garnered them a higher valuation. And this does not look like it's the case going forward. We can even see this in their basically financial statements. Basically, they said they expect for fiscal 2023 a total of 25 to 30 new net stores and 20 to 30 store remodelings, and only 3 new stores in basically, and in the last quarter there. And you can see the long-term trend for the store count. Before, in these early days, they're growing like mad. This is why they're, the company is increasing so much. It's going up so fast. But now the store trends have really started to plateau. 2019 to 2020, almost no growth. And even now when things are getting back to normal, they're not really growing that fast. This might mean they're starting to hit more of a market maturity, and I wouldn't bet right now in the short term to see a big reacceleration in the trend of the stores. So we're going to have to factor that in our analysis. There's a lot of other good things to like about Ulta Beauty. So first of all, one thing I like to look at, let's look at the return on invested capital versus the weighted average cost of capital. Now, Ulta Beauty has a really great return on invested capital. It's been getting higher and higher over the years. In the last year, 33%, and even in the mid 20s, in previous years, and their weighted average cost of capital has typically been below 10%. So even if they have to borrow money, which they don't, because Ulta Beauty actually has a fantastic balance sheet, which I'll show you later, they can get a much higher return when they do open new stores. The problem is right now, as we said, they don't see a lot of store opening opportunities. Maybe this will change in the future, but what we're currently seeing over the next year, the next two, we're not seeing much projections for many store openings. So let's scroll down to the revenue here. You can see all these stores opening, their revenue just explodes up. They're at $1 billion in revenue in 2009, and they're basically up to $6 billion in 2019, 7.4 in 2020. They had a drop of to 6.1 in 2021, which is a little bit off, probably because of the lockdowns or whatever else. And then back up to 8.6, then 10 billion, and we're at right now, last 12 months, 10.7 billion. Other great thing, gross margins have been growing as well. This is not obvious typical, and this just shows the company is still in not necessarily the growth stage, but they may be hitting that kind of like, peak of maximizing their margins, and maybe they continue their growth going in the future. They're going to have to lower those margins down again to fuel that growth. But their margins used to be in the mid 30s, usually around 35%. In the last year, it's been 39%. Maybe those will come down if they want to accelerate growth. That may have to be. They do have physical stores. They do have an e-commerce element. Maybe it's e-commerce that's helping fuel that. We'll see what they're doing. But when you're seeing the gross margins grow, they have a competitive advantage. And this is really, really, really good. And then we can basically see operating margin. It's been going up the whole time too. It means they're basically relatively keeping their selling and general admin in check. The selling, general, and admin, a lot of this for these physical types of locations, you have to have employees in the stores. So when the fact we're seeing the operating margin basically increase this whole time, or at least kind of keep the same relative ratio increasing of the gross margin, we can see they're keeping their selling, general, and admin expenses in line too. Now let's look at their interest expense. Well, there's nothing to look at because they don't have any interest, because this company has a fantastic balance sheet with virtually no debt, no interest they have to pay. This is really, really good. Basically, all that operating income, they just have to pay some tax on it, and everything else is for the shareholders. So really nice to see. And you can see net bottom line, their net margin has been increasing over the years. A lot of this is because of, the tax rates. The taxes, did get lowered, and it's higher than before, or lower than before. So their net margins are higher than before. But, we can probably expect to see their net margins maintain over 10% going into the future, or at least the foreseeable future. And you can see EPS has just exploded up because, along with increasing their margins, having their growth flying there, they've also been buying back shares aggressively too, and that's led them into the last year $25 per share, where we compare this to basically, 2010, where they only had 68 cents per share. So this has been a really good growth story, a really well managed company in a really good stage for like long-term prosperous growth in the future. So let's look at the current assets. 2.5 billion in current assets right now. A lot of that is inventories. Good chunk of it's, they got a healthy amount of cash and this and that too. And their total liabilities, current liabilities, just under 1.5 billion. So this is a really good current ratio. They got a lot of surplus on their current assets. So great current ratio, great financial, standings. Or it doesn't look like they're going to have to take on any debt in the future. We get to the total assets, 5.3 billion with virtually no goodwill. I'm going to ignore 11 million in goodwill. That's a rounding error in my world for a company like Ulta Beauty. And their total liabilities, 3.2 billion. A lot of this is only long-term capital leases. These are just future obligations of basically paying the leases on their stores, which a lot of people may look at assets. So really, the only debts they have are their current liabilities, which they more cover with their current assets. And that leaves total stockholder equity of over $2 billion. That's about 10% of their market cap, because their market cap is about $20 billion. So this is an extremely healthy balance sheet. Leaves them a lot of opportunities. They're doing share buybacks. They could do potentially acquisitions in the future, what they're not doing. Maybe they'll do some strategic ones. We're going to see what management does in the future. Because if they're going to want to keep that growth going, because the store count growth is slowing, they're going to have to do something with their money. Maybe they just want to buy back shares and keep it efficient. Maybe they want to buy out some of their beauty lines. We'll see. This might be a very interesting story for Ulta Beauty in the future, depending on what management does for potential acquisitions and growth opportunities in the future. So that's one of the key things you're going to want to watch on Ulta Beauty, because that could give them a reacceleration in growth and garner a higher valuation in the future. Let's look at the cash flow statement. Not much to see here. Good cash flow, positive cash flow from operations. Purchase of plant, property, and equipment, opening new stores, buying the stuff for they open new stores, they buy the equipment for the new stores. It's good. And basically the cash flow from depreciation, a little bit lower because they always have new stores. But even at this amount here, they're not spending that much more. So this is really, really good. And you can see basically purchase of businesses, virtually none. Really nothing to ignore here. Sometimes it's just currency stuff, hedging, whatever else going on, because buying and selling investments. Not important in Ulta Beauty's case. We can see what they're doing with their cash flow. They don't pay a dividend. They're not on that stage yet. They're just repurchasing stock, and I think that's what they should be doing in this early stage of the business. There's really no point of paying the dividend. It's better value for them to buy back stock. So let's now pop over to the interactive chart, see some relative valuations, and I'll show you why doing the flat relative valuation method kind of falls a little flat, doesn't work very well, because we're looking at a company who previously was growing at 18% a year and is now probably going to grow at a much slower rate. So you see price to sales ratio here, it is relatively low compared to these historical things, but you can see we had a high here, lower high, lower high, lower high. And when the fundamental trends of the business change, and in this case Ulta Beauty is probably entering a lower growth stage, this is also what happens. So it's like, who knows exactly how low it's going to get. I'm not entirely sure. Let's just draw some little lines here. You can see the downtrend there. Maybe there's going to be a downtrend. Let me get this stupid thing here working. A downtrend, something like this. I'd be targeting, honestly, looking at Ulta Beauty, a price to sales ratio somewhere around here, because this is a downtrending price to sales, and it does make sense because the growth is lower. And then again, also, we can see that same kind of like, flaw if we use a relative valuation for basically the price to earnings ratio here. We're sitting at an all-time low, but this is because the company's growth has slowed. The company was growing, really fast back here, and that garnered it a higher P ratio, but now that they're slowing down, that's not the case anymore. Let's also look at the revenue with estimate. This is from analysts here. I'm going to get to all things so we can see the future projections, which I already kind of showed you before, but you can see before, they're making these very large jumps, like, 3.9 billion to 4.8 billion, which is, a $900 million jump. In these future years, they're planning on growing less than that. So that's a very small percentage growth going forward, which is the reason why I think Ulta Beauty is probably going to start trading into a low teens P ratio. And we're going to kind of see that by just doing a little bit of a technical look at the chart. I think this is kind of the trend that's starting to form, and probably somewhere, this is a weekly chart by the way, in these moving averages is where probably Ulta Beauty may find a good value. If things get really bad, there is that inverted yield curve out there. There could be a recession. There's, whatever other headwinds. It could drop even lower, but probably at minimum, I'll be waiting for Ulta Beauty to get into the, mid 300s, 335. But also you see this price volume profile here. You're going to get a lot of support here if things go bad. So if Ulta Beauty hits a bad event, it's potentially coming down into the high, like 260s there, 250. Otherwise, probably could support here in the 300s, but that's kind of where I'm waiting for it right now. It doesn't seem to be having also a lot of positive momentum in 2023. In 2023, it's been net going down as the market's been going up. That's relative weakness. Market's not really interested in it, and it makes sense because the market just looks at what the store growth is going forward and is just saying, hey, we're not getting any store growth going forward. This company isn't a growing company anymore. We're going to want it cheaper. And that makes it up a great opportunity to buy Ulta Beauty. Once it does start getting down to a more attractive price, I'll do another video. There may be more fundamental factors to share in the future for that as well, which may affect the valuation. But for now, this is where I sit at Ulta Beauty. Not buying it right now, waiting to buy it potentially a little bit cheaper. And I hope you like this video. Remember to like, share, and subscribe, and I will see you in the next stock analysis video.